The companies that we have analyzed are Macy's and Nordstrom. Here's a look at both companies' largest shareholders.
Why do investors care about cost of capital? The cost of capital shows how much a firm needs to return on a project in order for the project to be profitable. It is a tool used to indicate whether or not the project is worth investing in.
What is our cost of debt financing? Debt financing is when a firm raises money for working capital or capital expenditures by selling bonds, bills, or notes to individuals or institutional investors. A company's bond rating is used to determine their spread, and that's combined with the risk-free rate to determine a before-tax cost of debt. We calculated both companies' after-tax cost of debt. A lower rating increases the likelihood of default. Macy's rating is a triple B, Nordstrom's rating is A minus. Since Macy's rating is lower than Nordstrom, their spread is higher. Macy's has a lower tax rate than Nordstrom. The overall result is a 3.02% cost of debt for Macy's and a 2.6% cost of debt for Nordstrom. So Macy's pays more for their debt. And this makes Nordstrom's the better company in this section. Here's a look at the numbers. The higher cost of debt for Macy's, although tax deductible, makes them a riskier company to invest in.
What is our cost of equity financing? Using 3 years of historical prices, we calculated beta for Macy's at 0.87 and beta for Nordstrom at 0.79. This means that both companies are less volatile in the market. Using the risk-free rate of 3% and the market rate of return of 15.49%, we calculated cost of equity for Macy's at 13.87 and cost of equity for Nordstrom at 12.87.
What is our overall cost of capital? To find this, we use the weighted average cost of capital. The weighted average cost of capital is the rate that a company is expected to pay on average to finance its assets, both debt and equity. An increase in the weighted average cost of capital means that a company is taking on more risk and it decreases the overall value of the company. The weighted average cost of capital accounts for a firm's amount of debt and equity financing, the cost to finance each, and the tax rate that a company pays. Macy's takes on less equity financing than Nordstrom, but they have more debt financing and a lower tax rate. Macy's weighted average cost of capital is 11.36% and Nordstrom's is 11.12%. Although Macy's pays the higher rate for both debt and equity financing, their lower tax rate balanced the weighted average cost of capital, and Nordstrom pays only slightly less than the overall cost of capital that Macy's pays. Could we lower our cost of capital by changing our capital structure? In order to find the optimal levels of financing that each company should use, we plugged each company's numbers into an Excel APV sheet. This shows the adjusted present values and the levels at which each firm would maximize their financing benefits. Our valuations show that both companies would benefit from a change in their capital structure. Macy's current debt ratio is 23%, and our valuation shows that their optimal level of debt would be an increase of 47% up to 70%. This would increase their beta, and their cost of equity would go up to 30.51%, which is an increase of 24.54%. Raising their debt ratio to this level would give Macy's a significant tax benefit. For Nordstrom, they would also see improvements if they adjusted their capital structure. Their current debt ratio is 17%, but our evaluation shows that their optimal level of debt is 60%, which is an increase of 43%. This kind of change would increase their beta, and their cost of equity would rise by 17.64% up to 30.51%. Overall, both companies would benefit from capital structure changes, but Nordstrom is closer to their optimal level of capital structure.
How would a financial restructuring affect the value of the companies? For Macy's to restructure their financing to their optimal debt and equity ratios, they would have to increase their amount of debt they take on it would make them a risky company because their beta would increase by more than double, which would make them a lot more volatile than the market. For Nordstrom to reach their optimal levels, they would have to increase their debt by more than triple of what it is now. It would make them a risky company to invest in because their beta would increase. However, it wouldn't increase by much. It would increase to 1.35, where it's not too much more than 1. Would more debt create unnecessary risks? More debt would create risk for the companies by increasing debt. Their beta would also increase, which would make them riskier than the market.
What does the competition do? In comparison to their competitors, both Macy's and Nordstrom have grown more in the past 5 years. Macy's has a lot more revenue than most of their competitors and almost double the revenue of Nordstrom. Macy's is a larger company than most of the competition. And although Nordstrom is not quite as large as Macy's, they are a lot larger than most of their competition. With a market cap of over $14 billion, aside from Macy's and a few other companies, there aren't very many competitors larger than Nordstrom. Compared to the market, Macy's and Nordstrom seem to both be large, strong companies.
Is our stock fairly priced? We went ahead and used the price earnings to growth ratio. The formula is PE ratio divided by annual earnings per share growth. Normally, a PEG of 1 is a fairly valued stock. So for Macy's, we calculated the PEG ratio at 1.42, and for Nordstrom, it's calculated at 2.52. Both of the stocks are over 1, so we decided that they're not fairly priced.